IAS 40 Investment Property. Introduction, Classification, Recognition. On the Statement of Financial Position under Assets and Non-Current Assets, investment property will be presented as a separate line item. In the Statement of Profit or Loss and Other Comprehensive Income, other income and other expenses will be affected. Please note, IAS 40 does not identify any other comprehensive income items. The accounting process comprises the identification of an economic event, the recognition and measurement of that economic event, and the presentation and disclosure of that economic event. This is a summary of the main content of IAS 40. Accounting treatment comprises recognition, measurement, and disclosure, and IAS 40 has an objective to prescribe the accounting treatment of investment property. This presentation will now focus on recognition, initial recognition, and subsequent recognition. IAS 40 paragraph 6 is the definitions paragraph. Investment property is defined as property, must be land or a building or part of a building or both, that is held to earn rentals or for capital appreciation or both, rather than for in the use, in the production or supply of goods or services or for admin purposes or for sale in the ordinary course of business. Owner-occupied property is property that's held for use in the production or supply of goods or services or for administrative purposes. So at initial recognition, to identify a property as investment property, it needs to meet this definition. It must be property that is held for rental to others or held for capital appreciation purposes. It must therefore generate cash flows that are largely independent of the other assets held by the entity. If you have property that is used in the production or supply of goods, like a factory building, or in the rendering of a service, or for administrative purposes like an office building, then it will be owner-occupied property and you'll have to apply IAS 16 to those. If you have property that is sold in the ordinary course of your business, those property will be accounted for in terms of IAS 2. Examples of investment property is included in paragraph 8. Land that's held for an undetermined use, property that's being constructed for future use as investment property. Paragraph 9 gives us examples of items that's not investment property. Property that's occupied by your employees is not investment property. That is owner-occupied. Please note, that is classified as such even if they pay rent at less than market-related rates. The rate at which the employees pay their rent is irrelevant. Property that is leased out under a finance lease, owner-occupied, property intended to be inventories, and property that's constructed or developed on behalf of a third party is not investment property. IAS 40 paragraph 10 deals with the instance where you have a dual purpose. Some properties comprise a portion that is held to earn rentals or for capital appreciation, and another portion that is held for use in the production or supply of goods or services or for admin purposes. So you have one property that is used as investment property, but also a little bit used for owner-occupied purposes. If you can sell these portions separately, an entity accounts for the portions separately. If the portions could not be sold separately, the property is investment property only if, very important, only if an insignificant portion is held for the use in the production or supply of goods or services or for administrative purposes. So what does paragraph 10 tell us? If you have one property that's used for two purposes, if you can sell those portions separately or you can lease them out separately, you can account for them separately, because then you can get the total value, you can split it up, The one portion you treat in terms of IAS 40 and the other portion you treat in terms of IAS 16. But what do you do if you can't sell it separately or you can't lease it out separately? Then you can't split the value. Then you can treat that entire property as investment property as long as the portion that's owner occupied is insignificant to the total property. IAS 40 paragraph 11 to 13 deals with the scenario where you are providing additional services to the occupants of property. So you're renting some or other property out, but on top of that, you also provide additional services to the occupants. An entity treats such a property as investment property if the services are insignificant to the arrangement as a whole. An example, when you are the owner of an office building that provides security and maintenance services to the lessees who occupy the building, that security and maintenance services can be considered insignificant, and you can therefore classify that property as investment property. In other cases, the services provided are significant. For example, if an entity owns and manages a hotel, services provided to guests are significant to the arrangement as a whole. Therefore, an owner-managed hotel is owner-occupied property rather than investment property. It may be difficult to determine whether these ancillary or additional services are so significant that a property does not qualify as investment property. For example, the owner of a hotel sometimes transfers some responsibility to third parties under a management contract. The terms of such contracts vary widely. At one end of the spectrum, the owner's position may, in substance, be that of a passive investor. At the other end of the spectrum, the owner may simply have outsourced day-to-day functions while retaining significant exposure to variation in the cash flows. So how do you decide? IAS 40 paragraph 14 says, judgment. Judgment is required to determine whether a property qualifies as investment property. And you have to develop certain criteria in your business to determine how are you going to classify this as investment property or not. And that criteria will also have to be disclosed in your financial statements. So the summary of these additional services, this is where you have investment property that you're renting out, either a hotel or an office building or whatever the case might be. But on top of just renting that out, you also provide some services to the occupants. If the services are insignificant to the arrangement as a whole, it can stay investment property. But if the services become significant, the standard says you are now using that property as your main business operations and it becomes owner occupied. Where it's difficult to determine, you apply judgment. There is a section in paragraph 15 dealing with a parent and subsidiary situation, which we'll do in the group statement second semester. Recognition. What is the recognition criteria? Every time you incur costs regarding investment property, you evaluate those costs against the definition that we've just discussed just now, probability of economic inflow, and that the cost can be determined reliably. Every time costs are incurred before you can capitalize. Subsequent recognition. Day-to-day servicing, paragraph 18. Profit or loss as incurred as repairs and maintenance. It is not capitalized to the cost price of the investment property. Regular replacements, paragraph 19. You recognize in the carrying amount the cost of replacing such a part, but to prevent overstatement of your investment property, the carrying amount of the parts replaced must be derecognized.